For decades, fixed income was the foundation of financial safety. Bonds, CDs, treasuries, pensions. They were not meant to make you rich. They were meant to let you sleep at night. If you are over 55, you were taught that once you reached a certain age, you reduced risk, shifted into fixed income, and protected what you had built. That rule worked for generations. Today, it no longer does. And the reason fixed income no longer feels safe is not confusion. It is reality. Fixed income was built for a world that no longer exists. In the past, interest rates were high enough to compensate savers. Inflation was present, but manageable. When you bought a bond, you knew three things. You would get paid, your principal would be returned, and your purchasing power would be preserved. The math made sense. Yield exceeded inflation. Stability was rewarded. That relationship has been broken. The first reason fixed income feels unsafe today is inflation. Even when bonds pay interest, that interest often fails to keep up with rising costs. A 5% yield sounds reasonable until inflation runs at 4 or 5% as well. In real terms, the return is close to zero, sometimes negative. You are getting paid, but you are still losing ground. This is not a temporary issue. Inflation has become more persistent, more unpredictable, and more damaging to conservative strategies. For retirees and near retirees, this is devastating. Fixed income was supposed to protect purchasing power, not slowly erode it. The second problem is interest rate risk. After years of near-zero rates, central banks were forced to raise rates aggressively. When rates rise, bond prices fall. Many investors discovered something they were never warned about. So-called safe bond funds can lose significant value. Long-duration bonds suffered historic declines. Portfolios designed for stability experienced volatility they were never meant to endure. This created a painful contradiction. If you held bonds before rates rose, you lost value. If you buy bonds now, you face uncertainty about where inflation and rates go next. Fixed income stopped being predictable. The third issue is reinvestment risk. When bonds mature, the new yield may not compensate for higher living costs. Retirees rolling over CDs or treasuries find themselves constantly recalculating. Stability turns into ongoing exposure to policy decisions made far away by people whose priorities are not retirement security. Central banks are at the heart of this problem. For more than a decade, monetary policy prioritized cheap borrowing and asset inflation. Interest rates were held artificially low. Savers were punished. Fixed-income investors were forced into longer maturities or lower credit quality just to earn something. Safety was traded for yield, often without fully understanding the risk. When inflation finally returned, fixed-income portfolios were caught in a trap. Rates rose, prices fell, and purchasing power declined. This was not mismanagement by individuals. It was the result of a monetary regime that no longer values savers. Credit risk is another growing concern. Government debt levels are historically high. Corporate balance sheets are strained. Municipal finances face long-term pressure. Fixed income depends on trust. Trust that issuers can and will pay. As debt burdens rise, that trust feels less absolute than it once did. Even government bonds, once considered risk-free, now carry hidden risks, not default risk, but inflation risk. A bond that pays exactly what it promised but buys far less than expected still fails its purpose. For retirees, this creates a sense of betrayal. Fixed income was supposed to be the safe harbor after decades of work. Instead, it feels like exposure to forces beyond control: inflation, policy shifts, fiscal excess, and global instability. Pensions face similar challenges. Many are underfunded. Returns assumptions are strained. Inflation increases liabilities while assets struggle to keep up. What was once a guaranteed promise now requires careful scrutiny. The emotional impact matters. Fixed income was about peace of mind. When that disappears, retirement becomes defensive. Spending is delayed. Joy is postponed. The future feels uncertain even when balances look adequate. Younger investors can adapt. They have time. Retirees do not. Fixed income was the tool designed for this stage of life. Its failure is not academic. It is deeply personal. The uncomfortable truth is this: fixed income did not become unsafe because people misunderstood it. It became unsafe because the economic environment changed. Inflation returned. Debt exploded. Monetary policy shifted priorities. The rules that once protected conservative investors were rewritten. This does not mean safety is impossible. It means old assumptions must be questioned. Blind trust in fixed income is no longer protection. It is exposure. Understanding why fixed income no longer feels safe is the first step toward adapting intelligently. Not chasing yield, not panicking, but recognizing that the world your retirement plan was built for is gone. And pretending otherwise is the greatest risk of all.